Alright, let's continue with the penny stocks for dummies, chapter summary. So chapter 5 talks about developing a strategy. Um, we can start with trading risk-free with just paper trading. We need to measure the performance in percentage, not absolute dollar amounts. Don't invest all the money at once into one stock. Buy and follow several penny stocks at once. Don't have unrealistic goals just because it's play money. Adjust strategies regularly while practicing. We can also just track the penny stocks. We identify best or worst trades each week or month and try to learn from it. We'll need to compare the win-loss ratios to the overall markets, and you can increase the number of stocks being watched if there's no activity.
Mic off. Mic on.
Characteristics of successful penny stock traders. Um, they have realistic expectations. They have high tolerance to risks. Not married to companies or stocks. Quick, which means they are quick to cut losing positions, and they don't pin all hopes on any stock. They are also patient. They have ability to monitor the stocks. They understand volatility with random ups and downs versus merited up and downs due to changes in business. They have the ability to make decisions based on research, not impulsiveness. They're willing to do due diligence and plus more. So how long will it take until profitable? Um, Day to day, there's up and down. 10 to 20% is very common with penny stocks. But if you want 1,000% returns, you will need to hold it for years. Chapter 3, do your research. So this chapter talks about ways to the ways that you can do your research, such as buying the so before you buy the stocks, you should know what the company does to make money, what is the expectation for the shares, and what factors to watch for to ensure it's on the right track. Doing due diligence. Um, you want to do in-depth research with fundamental analysis, which is covered in chapter 10, abstract review in chapter 12, and technical analysis in chapter 13. Places you can do the research. You can use stock charts. You never want to be surprised by the activities of the price. You look at price trends and trade volume. Stock screeners in chapter 7. Company financials in chapter 10. And press releases. So you should check how each stock moved before and after the company press releases. Some move quite a lot in anticipation of the release and drop after. Some do nothing. Media outlets, stocks can react significantly to positive or negative media news. Paid analysts. You should be very cautious of what they say since they are paid by the company. They could have some valuable information on the company. Investor relations, they are here to answer questions. Penny stock newsletters and chat rooms, paid versus free newsletters. Paid ones are more likely to be reliable. We should wait to see their stock picks to see if they are actually profitable, or you can back test. You can also call the company. Questions to ask the company when you call: current employee numbers and what it was 2 years ago, and what they expected to be in 1 year from now. Why is it going up or down? If it's going fast or slow. Turnover rate of the employees, is it average in the industry? Sales generated from the US or overseas. Main competitors, CEO history, product attrition rate, what percentage of customers stop using services, and why. How many years do you think your resources can last? Such as a mining business, you should ask this question. Is there a plan to raise more money in the future? How much and when? Growth targets. And how do you plan to achieve that if it's not there yet? Gauge the contact's morale. Does the person sound enthusiastic about their company? Guidance. Most popular guidance number is earnings per share, total revenue, operating margins. Generating your own guidance data from research, focus on total revenue, profit margin, earnings per share, debt load, expectations, and stock prices. Expectation um, expectation of the company moves the price more in penny stocks due to fog of war. Less exposure and less analysts covering lead to more surprises. They're usually one-trick ponies. They're more likely to be affected by one aspect of the business. Stocks tend to go up if beating expectation of multiple analysts. Missing estimates can be first sign of the company be in trouble. Follow the trend of the market. Pay attention to current social media trends. Some you can follow, some you should stay away from. And then there's market and company risks. Market downturn. Selling in reaction to downturn could be a mistake if major drops has already happened. Buying when everything is down is a good idea. Company specific risks are more serious and potentially change your outlook of the company. Alright, so chapter 7, how to pick a winner. So we're going to look at elimination criteria, what does Peter Leeds do, and also the screeners. What kind of screening criteria? So for elimination criteria, it's broken down into market, industry, share price, and company size, and trading activity. So avoid low quality trading markets. Focus on industries familiar to you. Focus on share above certain values such as 50 cent, or you can use market cap of the company like 100 million capitalization. Also avoid super low volume stocks. So Peter Leeds' approach, he only trades North America markets, no pink sheets, Avoid companies involved in certain industries such as airline due to the risks from competitors, worker strikes, terrorism, fuel price spikes, accidents, shift in travel pattern, um, hot industries like marijuana, Bitcoin at this time, banking and insurance. Financial results are reported differently than most companies. They're more difficult to properly interpret. Trading, holding companies, they don't. He doesn't trade. Educational companies, notoriously competitive and underperforming. So the screeners criteria for to focus on is price, trading, exchanges, industry, price situation. Um, so and then holding companies, class of shares, weak names. So for price, the percentage of its 52-week high or low, trading volume, if it's triple trading volume, triple of the average trading volume. Volatility, look for twice volatility as the overall market or a fifth of the current market. Fundamentals, PE greater than less than 12. Holding companies usually has these companies usually have holding in their name. They have a different set of rules and should be avoided in general. Class of shares, there are Class A, Class B. You can avoid them by removing the .A or .B on the ticker symbol. Weak names, industrial production company, or something like that, we should avoid. So chapter 8 talks about the manias. So in this chapter, he goes over penny mania of the past, surviving and profiting from them, and how to spot the next mania. So for the past, he gives example of the pot penny stocks. So in March of 2012, there's recreational marijuana becomes legal in Colorado and Washington. So late 2012, companies start jumping on the trend. From 2012 to 14, company values start popping up. These companies' values start going up. In early 2013, second wave of the companies jump on the bandwagon using cheap tricks like adding marijuana or cannabis to their name. Early 2013, pot penny stocks spike from a couple of dollars in the early 2013 to $200 in 2014. Then in early 2014, there's the collapse. The same stocks fall from $200 to $20 within 2 months, and then to $1. And a few months later, 2014 to the present, other states start legalizing recreational marijuana, but the mania has gone and passed. Other possible manias: 3D printing, self-driving cars, AI, space exploration. So surviving and profiting from penny stock manias, things to remember. Uh, Try to recognize the mania, focus on fundamentals, timing is everything. Check your greed, always better to cash out too soon than holding on for too long. Watch media coverages, levels. If you're seeing the news on the front page, the stampede is already played out. And then the grandpa, grandma indicator, everybody's talking about them and how to spot the next mania. It takes time for people to forget the prior mania. Usually takes 4 to 5 years, 4 to 6 years for the next one to come, and then about 10 years for a major one to come. Predicated by something new or unique. Chapter 9 talks about trading strategies. Main points are scaling in and out, average up not down, stop losses, position sizing, diversification, trading windows. Okay, so for scaling in and out, the benefits are you can change your mind easily. You have more time to think. Change. There's more chance to react to events. Minimize potential losses and mistakes. Dollar cost averaging. Lock in results. So you can sell a portion when the price goes up a lot. Keep your options open. You still have money left on the table for other better opportunities. Scaling in and out. So you don't put all the money in at once, basically. The downside is you can miss out on the upside and more commission fees. Average up, not down. Downside of averaging down, you have more misplaced faith in the company. You have misplaced faith in the company. You think you are getting a bargain, but the company could be going to zero, which are a lot of these penny stocks. Upside of averaging up, your choice has been validated. Penny stock is behaving the way you predicted, increasing visibility of the stock. That's why it's going up. Stop losses, selling when the stock goes down to a certain point automatically is preferred versus mental stop losses orders, because selling at a loss is very hard to do mentally. So you will set a automatic sell. Avoid getting stopped out due to volatility. To avoid that, you set the stop loss on shares with higher trading volume. Use stop loss on penny stocks with low volatility. Use a larger stop losses. Buy on price dips. Use trailing stops, which is a stop loss that moves higher as the price rises. Position sizing, limit each position to a percentage of your entire portfolio. Works better with larger portfolios. You can do 5 to 20% depending on your portfolio size. Diversification. There are many ways to diversify. You can do it by industry, company size, share price, region of the country or world, volatility, and types of security. However, pinpoint investing has higher risk but also higher rewards. Trading windows in general, 80% of any penny stock move happens over 20% of the trading days. Usually happens as a result of some event such as new product launch, lawsuit result, FDA clearance, strong quarterly results. Research those dates. Know when to take profit. Any shares going up significantly, consider taking at least a portion off for profit. Avoid the loss of profit when stock goes up too quickly and inevitably comes down as investors tend to take profit. When the outlook is bleak or when trading volume declines, most upside is fueled by higher investor activity. If the volume goes down, price tend to go down as well. Know when to sell at a loss. When the price hits a stop loss, when trading volume increase and price falls, when trading volume decrease, trading volume fraction of 3 to 6 months average means investor interest. If the trading volume is a fraction of the 3 to 6 months average, this means that investor interest is trading, and that's a good sign. If the technical analysis indicate a downturn, when an event has minimal impact, if you expect an event to raise the price and it did not, there could be something else going on. When you anticipate further downside, so just sell it. Chapter 10 talks about fundamental analysis. So there are a few things we can focus on: the income statement, balance sheet, statement of cash flow, numbers to look at. And then he talks about acting on the analysis, management, and outlook of the sector. So for income statement, top line is sales and revenues, cost of sales or cost of goods sold. Then there's gross profit, sales minus the cost of goods sold, operating expense or overhead such as research, development, and advertisement. Bottom line is the net income, gross profit minus operating expense. So on balance sheet, you see assets and liabilities. For assets, inventory, factories, machines, cash, outstanding invoices. There's also long-term asset, which is less than 1 year, and short-term assets less than 1 year, and long-term assets. For short-term assets, these are accounts payable to the company, cash on hand, monthly sales. For long-term assets, factories, bonds redeemable in several years, or real estate. Liabilities, these will include debt, monthly rent, account payable, equipment lease. Also breaking down into short-term and long-term liabilities. Short-term will include monthly rent, bills, interest on credit. Long-term will include debts not due over 1 year, mortgages, loans. A building that the company is paying mortgage on will be appearing on assets, and also but its mortgage, it will be appearing on the liability side. Statement of cash flow is a snapshot of the financial position. These usually you will usually see operating activities, investing activity, financial activities, supplemental information. Common things will so for operating activities, you see profit or loss as displayed on the income statement. Purchases and sales of the long-term assets, dividend payments, issuance or repurchase of bonds or shares, income taxes, interest payments, gain or loss on foreign currencies. So other common things you can see will be borrowings, dividends, stock offerings, adjustments for changes in foreign exchange rate, loan payments, depreciation, adjustments to goodwill, changes in account payable, taxes. There are also off-balance sheet adjustments, changes in company's perceived value of some product or asset. Um, so you will see a change of the balance sheet, but does not materially affect the company's cash flow. Other numbers to look for, or things to look for, you should compare current statement to previous period. If you see a doubling of sales from one year ago, tripling of liabilities, you need to find out why. Comparing to other competitors, if sales growth versus other competitors is going up, this can signal the company is taking market share. Comparing to sector, not direct competitors, but still outperforming the market. Investing activities, see if the company is investing in stocks and losing money. See if there's a big gain or loss in these categories. There could be something fishy. Trends, if you see revenues growing, that's good, but it's even better if you see the growth rate growing. Debt is shrinking, assets are growing slowly, liabilities can get bigger due to larger inventory purchase to fulfill bigger orders, or if they need more staff. Increasing liabilities with expanding assets is good. Earning trends, profit margin, and financial ratios. Acting on these analysis, you look at price, past experience, portfolio balancing, situation timing, such as an event that triggers the change in the environment. You should act on these analysis. Look at management, history of the management team. Salaries should be 250K for these penny stock companies. Current ownership, use dollar terms to gain perspective of the total value these companies are to the individual. 5% of company versus $45 million worth of stocks. Insider buying and trading not indicative of how the company is doing. Outlook for the sector and industry were developed from different aspects such as companies themselves, analysts covering the sector, investors' personal experience influenced by macro and microeconomics.